Welcome to the Off Street podcast featuring Adam Reiner and Sean Dan. Off Street contains general information that is not suitable for everyone and contains certain forward-looking statements of future possibilities that, due to known and unknown risks and other uncertainties and factors, may differ materially from actual results. As such, there is no guarantee that any views and opinions expressed herein will come to pass. Off Street is presented for informational purposes, and nothing contained herein should be construed as a solicitation to buy or sell any security or as an offer to provide investment, tax, or legal advice. Additionally, this communication contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to their accuracy or completeness. Adam and Sean are employees of Marshall Financial Group, Inc., a registered investment advisor. For additional information about the firm, including its services and fees, send for the firm's disclosure brochure or visit advisorinfo.sec.gov.
All right, Sean, it is Tuesday, June 20th, 3:30 in the afternoon. Welcome back.
Thank you.
How was the Caribbean?
It was nice, very nice. Water was warm, sunny every day. Got a nice little tan. Well, slight burn, slight tan going, but yeah, it was a really good time. How was your Father's Day?
It's nice. It was a quick, long weekend. So, what did you go on a vacation or a trip?
This was a vacation. It was a pure vacation. Just my girlfriend and I, just to like relax and have fun. No other responsibilities beyond that. So I'd call this a certain vacation. I know you,
vacation.
I know you make a delineation between trips and vacations when you go away.
I do. Yes. I think if the car is packed and filled with stuff, you're going on a trip. But if you're bringing just a suitcase somewhere, you're probably going on a vacation.
Okay, that's a good way. That's a good way to put it. All right, so anywhere you drive, so like, well, you go down the shore.
I'd say that's a trip.
That's a trip when you go down the shore. So a flight is really the.
Doesn't have to be a flight. You could just be going somewhere with just a suitcase.
All right, that's interesting. I like that.
It's the difference between a lot of, I don't know. I feel like even going down the shore, you still have to decide a lot of stuff. Like, are you going to cook food? Are you going to go out to dinner? Because if you're just going like on a true vacation, you're probably not going to cook, right?
I like this whole philosophy. This is a whole new world to me. I knew you made the separation. I didn't know this much thought went into it.
There you go. Hey, like the Phillies haven't lost since you left.
I know that has been fun.
One time.
Maybe it's just because I haven't been able to watch them. It's nice to just check the score every night and they win. I think they won 13 of their last 15.
You know, if they go far in the postseason, you may be going on another vacation.
All right. All right. I'm not opposed to that. If you had to put a % chance to make the playoffs, where are you at right now? What are you feeling?
I think they get it.
Because I saw there's like a analytics site called Fangraphs.
Yeah.
And they have them at almost dead 50% right now. I think it's like 49%.
Which I feel like 2 weeks ago was 25%.
Yeah, they said in the past 2 weeks they've jumped like 25%. But I'm feeling very optimistic. I feel like the number is probably more like 70, 75 in my mind. Probably fans' minds.
Yeah.
But
I like to believe it.
Hot baseball team. Hits June and they remember how to play baseball.
Yeah, things are trending the right way for sure. You know, Philly sports are doing well. Market's doing well.
What isn't there to like?
Dude, should we do a quick market check-in?
Yeah, let's check in.
So S&P closed Friday a little above 4,400. Began the year around 3,840. So far, outperforming at strategist estimates for S&P is for where they thought year-end S&P would be.
Approaching the 6-month mark of the year. Market's up more than 14% year to date. As of Friday's close, we've come off a little bit. We'll see where we close today, but roughly up 14% year to date. Not bad for what was supposed to be a choppy, flat to down year, according to strategists at least.
Yeah, I think they were looking for, median estimate was S&P 4075 at year end, so well above that. There were some new estimates that came out on Friday. Strategist estimates held firm, median 4,100. So not a big change there.
Not to automatically call these people wrong, there's 6 months left in the year, but I think it's a good reminder of strategist forecasts, analyst forecasts are there to look at. It's not the end all be all. They don't know, we don't know. At the end of the day, no one knows with any level of certainty where the market's going to be 6-12 months down the road.
There was some Fed news last week while you were away.
Mm-hmm.
Not sure if you had a chance to see that while you were on vacation.
I read the cliff notes. I wasn't able to listen to the full press conference.
So in a nutshell, I guess, Fed didn't raise interest rates on their dot plot, as was become known, which is their summary of economic projections. They think maybe they have to raise rates 2 more times this year, 0.25% each time. Market so far doesn't necessarily believe that they'll have to raise 2 more times. Market kind of just thinks 1. Though for next year, on their projections, they think Fed funds rate falls back to 4.6% by year end next year, and then 3.4% in 2025. So the Fed is, as of right now anyway, forecasting rate cuts next year at some point.
Which feels fine. Like if we hit a recession, I feel like we'd be cutting more.
Maybe just inflation gets back to an acceptable target range.
Which you were pointing out earlier, we're looking pretty good there. If you look at
the nowcast, we're looking at 3.1% year over year inflation for CPI. And then the nowcast for PCE is 2.9, which PCE is the Fed's preferred measurement.
It was pretty moderate to me. Feels like stable, relatively stable prices to me.
I think it gets harder to make the case that they'll need to raise more aggressively if headline inflation does come in at those numbers, barring any surprises.
Yeah. And it's going to be a little bit contingent, I guess, on where we expect to go from there. But there's no obvious catalyst to send us back up to 5, 6, 7. We peaked at 9%. There's no obvious catalyst that's going to send us there. So, like you said, if we get back down to the 2s and 3s, probably doesn't make a ton of sense to say super restrictive way beyond the next 6-12 months.
Which feels like a good chance to talk about interest rate risk and reinvestment risk.
Yeah, the script has definitely flipped.
Interest rate risk, prominent last year. Fed raised rates more than 4%, and we saw Barclays aggregate bond index decline double digits. This year, the Fed has raised a little more than 1%, and bonds are actually up slightly, low single digits. Cash is now earning something real. Money market funds somewhere around the neighborhood of 5%, just ballparking, where's the best place to put money? And the answer is that really depends. If interest rate risk is the chance that the value of your bonds falls from rising rates, reinvestment risk is kind of the other side of it. How would you reinvest that money if rates were to fall? And that's kind of the dichotomy that's breaking out right now. Feels like if you have no short-term cash flow needs, money market funds make sense. But if you're truly investing the money, is it best to have that money in a money market fund, which is yielding something decent today, but has the potential to fall should the Fed have to change course, like their economic projections expect, and rather put that money in maybe something longer, like a 5-year treasury, where you can earn 4%, but instead of earning 5% over at least for a year or immediately, barring any Fed funds changes, you know what your yield's going to be for at least 5 years. So you kind of push that rate risk out for a while.
Yeah, you can lock in the rates while they're still high. If you're in the camp of rates will go down soon here, which if we use Fed funds as that predictor, the dot plot would suggest that. So I think that's been the big shift this year. Is last year was like everyone wants to be short duration because all of us know rates have to go higher. If we're approaching a peak, even if we may not be at that exact peak yet, I think most people would probably believe 2, 3, 4 years from now will probably be lower, barring any major unforeseen event. So maybe now's the time, do we lock in kind of a higher, longer term rate to make sure we still get it a few years from now?
Yeah. And there's the potential for some juice there. If rates do fall, the value of those bonds could go up. So you get there's a whole total return package.
It feels good talking stocks and bonds right now. Feeling pretty positive how they performed this year. Obviously, a lot that could happen, but feeling more comfortable, I guess, looking forward than maybe we did this time last year. There was a tweet from Sam Rowe, who's a popular finance blogger. He writes really good stuff. If anyone wants to check him out, but he tweeted, "Permabull is a weird way to characterize people who are usually right." I like that.
I love that. The market's usually up 70, 80% of the time. So it's a good take.
There's no need to be unnecessarily bearish. Like you said, it's an historically it's been an asymmetric thing. On any given 1 year period, if you think stocks are going to go up, you're going to be right. You were right 70 to 80% of the time. And sometimes we like to overcomplicate it and like to be bearish just to sound smart.
Kind of in with that perma-bull thought process. The market has done very well this year. There's that popular cycle of investor emotion chart that's out there, where if you consider the peak of the cycle as you say it,
Euphoria.
in that was probably 2021, February 2021, where meme stocks were going crazy, risk was prevalent, everyone felt great about investing. People who probably never invested before were opening accounts. To the trough, well, maybe that was last year, we don't know, where there's capitulation, despondency, then you start working your way back up. I don't know. Given the way the fourth quarter felt last year, that felt like a trough. Like, it just felt bad.
Yeah.
I think around that time, most people were wondering, should they continue to stick with this plan that they have? Should they be making changes in their investments? Should they just go to cash and start to earn 4 or 5% on money market fund rather than taking investment risk?
Felt like October. People started to get real antsy. October 2022.
Yeah. I mean, at that point, the drawdown had persisted almost, we were what, 9.5 months into the drawdown.
Down nearly 20%. Actually, at that point, we were down more than 20% at that point.
Yeah. Those were the lows. And then you start to work yourself out. And as you work yourself out of the trough, it goes skepticism, hope, relief, optimism. Of those four, where do you think we are today? It's got all that. There's that AI news. It seems like AI and tech are the drivers of market performance so far this year.
I think we skipped quickly. If you asked me 2 weeks ago, I probably would have said skepticism. When we were up like 7, 8, 9%, and it was kind of felt like a hated rally. Most people like weren't accepting of the rally. To now, over 2 weeks, it feels like we've gone up 5, 6%. Last week, it felt like we were going up 1% every day. I think we've quickly jumped to optimism. And now people want to talk about positive prospects. Obviously, the AI frenzy has been going on for maybe a few months now, but it feels like we've jumped a little bit. The AAII investor sentiment numbers that we look at every so often, where they ask people, are you bullish or bearish? The percentage of people responding bullish spiked about a week or two ago.
Yeah, it went from the mid 20s to
like 42.
Yeah, into the 40% range,
which is a huge jump. And one of the first weeks in the past year and a half where bulls outweighed bears pretty significantly. So I would say the first 5 months of the year, I would say we're in that skepticism camp. I think we've quickly jumped over, what was the next one? Hope. I think we kind of skipped hope, and we're now at optimism.
We skipped over hope and relief.
Hope and relief, or maybe relief optimism right now. I think people, like we talked about too, the VIX, the kind of the measure of expected volatility in the market is very muted as well right now. It feels positive, relief, optimism. Summertime, everyone's feeling good. I think we're kind of settling in there right now.
I feel like we're still at hope.
You're still at hope?
Yeah. Even just listen to the commentators and read through some of the commentaries. It's gone from we'll likely have a recession to hopefully we can avoid a recession and earnings will grow, or hopefully we'll be able to see material performance from the number of times AI has been mentioned on earnings calls. So it feels like there's a lot of hope right now. And I feel like that because markets have done well, investors are hopeful they'll continue to do well. And maybe that's boosting bullish sentiment right now.
I think also too, isn't it? No one wants to be the first to call the rally, right? Like no one wants to say like, we're here, we're rallying, because as soon as the market turns against you, you look like an idiot. So I think I agree insofar as like no one's going to declare optimism at this point. They're going to be hopeful because we're still fresh off the scars of 2022. We don't know how much, at least this most recent rally, has legs yet. So maybe if we hold on for the rest of the summer, do you think we get to optimism? Like, what do you think we need for that?
I think if we can get through next earnings season, so the one that'll start in July for the end of this quarter, and earnings projections continue to migrate higher, or at least they don't erode, maybe we'll start to see some plans for the way some of these companies will actually incorporate AI into their outlook, since it was such a popular term this past earnings season. Maybe that'll provide the market relief in the near term. And then once we get into the fourth quarter, second half of this year, if it really looks like a recession is not going to happen, earnings are going to grow, maybe we reach the optimism stage. You had found an interesting article. It's an old new article.
Yeah. This was a good beach read. This is one I came across last week.
It's from the Wall Street Journal.
So yeah, this was an article. This was a beach read. Someone on Twitter had kind of said, let's check back in on this manager. There was an article 7 years ago in the Wall Street Journal that took a look at the chief investment officer of the Nevada State Pension Fund. And it's a $35 billion fund run mostly by him and kind of a bare bones staff. And in the article, he talked a lot about how he had come to realize the power of more passive instruments and how that can kind of reduce complexity while still getting solid to even kind of above average results in portfolios. And so, for example, he talks about his U.S. equity bucket was completely made up of an S&P 500 index. His bond bucket was almost exclusively a simple bond index. And then he had a little bit of private equity and a little bit of private credit. But the whole crux of the article is, as a manager, you're bombarded with news every day. And if you really wanted to, you could trade on every little tick of the market, every little headline that comes across. But there is a power and there is usually a long-term benefit to kind of resisting that. And he had kind of tapped into that. And it talked about in the article, as of 2016, over 1, 3, 5, and 10-year periods, he had outperformed CalPERS, which is the California State Pension, which has a massive team and is invested in a lot of complex products. Checking back in 2023, he still has outperformed them on many of those timeframes. But it was just a good read and kind of a reassuring read of, you don't need to be overly complex to get good results in investing.
I think that was the big takeaway from the article. And that when you think of pension investing, like CalPERS, they're on Bloomberg all the time, talking about what their active strategies or private investments that they're going into. And here he is, the CIO of Nevada's pension fund, just using widely available public investments, reducing complexity compared to other pensions, and having very good performance.
Great performance.
And, you know, I think it's funny in the article where they ask him, since this was written in 2016, did the elections affect your portfolio? No. Oil prices? No. The similar questions we get from clients about, there's this X headline out there, should we be taking action? Most of the time, the answer is no. We know there's going to be variability in markets and headlines, and that's all going to move portfolios. So unless something drastic happens, the answer is usually no, we shouldn't be taking any action right now. So it's just a good case study in saying this is in practice. And in here, he says there's a difference between watching and acting. And his predecessor had made the comment that sometimes doing nothing is harder than it looks. That restraint is needed to practice inaction. And in here, he said something that resonated with me, I think we spend a lot of time doing. He said, I spend a lot of time researching things we ultimately don't do.
Harder than it seems, because we get 50 emails a day from people trying to sell their funds and these new strategies. You know, usually those things look good in retrospect, not always great in execution. And those things are always there to kind of knock you off course. And you have to decide, like, what is real and what is not. And so often, you know, staying the course and staying in what you're invested in, staying passive, usually is going to get you pretty good results with a lot less stress and a lot less kind of that complexity cost that comes along with that stuff. I really like that article. I think it's really great.
When we were talking earlier about it, I said, you know, it's kind of like sports teams. The ones that usually win championships spend time It could be, I guess, it could be the NFL, NBA, baseball, wherever, hockey, even golf, since the Open was just this past weekend. The individuals or teams that win usually spend more time focusing on doing the fundamentals correctly, more so than spending time working on like gimmicky plays. And I think that's what he does.
Absolutely.
So there was this story that was published on financialplanning.com while you were out. And I think this is a good demonstration about our industry. The title of it is Emojis, a thumbs up for some advisors, give regulators frowny faces. And basically, this is summarize the article very quickly that people can use emojis. Regulators aren't quite sure. They're talking about FINRA here specifically. Not quite sure how to interpret them. There's a little ambiguity to them. It does a frowny face mean a complaint? Is a thumbs up an endorsement? All that stuff. And I think it's just for some clients, or maybe clients know this or don't know this, that financial services is a very regulated industry. I think at times there can be a sense of frustration about things we can and can't do. Especially if you're not in the industry, it's like, why can't you just do this? And it's like, well, there's a regulatory reason as to why we can't do that. Now it's making its way over to emojis. So if you send an emoji, or we were to send an emoji, it could just be looked at in an odd way by a regulator.
Like you said, people ask all the time, like, where should I be invested right now? What's a good place to put my money? Where should I buy? Where should I sell? And you see Jim Cramer or whoever on TV who goes on at night and goes, buy, sell, buy, sell. And there's a different standard kind of within the industry. And you have to be very careful what you say, because things that you might not mean as an endorsement, when you just read it on paper or you see like a hard eyes emoji attached to it, suddenly looks like, oh, they love this product. Like they're saying buy this product. And it just becomes very murky. And so
like they talk about the crying face emoji in here, that a client could reply with that, and it could either mean sadness or it could mean joy, right?
Yeah.
It could mean two things.
There's something about that the other day I saw a grandma didn't understand the emojis and would reply with the laughing, the laughing with the tears coming out emoji. She thought that was like a sad emoji. So she would reply to like sad things with like the laughing, crying face. So it's one of those things, and I think it can frustrate a lot of people when, if we write a blog or someone else in the industry writes blogs and they're not like super clear or super definitive on an area, or doesn't use emojis.
Even a podcast, perhaps.
Even a podcast, perhaps. Like you just have to be careful with those sorts of things, because in this industry, we're talking about people's money, their livelihoods. So it's tough. But definitely, who would have thought, I guess, when the emoji was created, 10, 15 years ago, that it would wreak havoc on the financial advisory industry.
How do you use them or not use them? But
gotta be careful.
Interesting article.
Yeah, definitely. Shall we do some uncorrelated?
Let's do some uncorrelated. Which one would you like to start with?
Start with Beyoncé.
So Beyoncé is being blamed for fueling inflation in Sweden, according to a CM or NBC News article. Beyoncé is on a world tour right now that is sold out. And according to this article, it is a record-breaking tour. According to one economic expert, she's partially to blame for Sweden's stubbornly high inflation. Inflation was expected to fall in May in Sweden to 7.8% year over year, but it only fell from 8.4 to 8.2% during the month. And she had just so happened to kick off a tour in Stockholm on May 10th and 11th, and fans were flying in from the United States and elsewhere to see it because it was cheaper. It's basically what it boiled down to. And as a result of the surge, there was hotel price increases and other costs from fans, and that offset any other declines.
This is ridiculous, right?
It's kind of crazy.
No, I'm not even that. I'm just saying, like, it's dumb. Like, do you buy this? That 2 Beyoncé shows in an entire month move the needle for an entire country's inflation number. This feels like deflection. This feels like, we're not gonna have a good number, guys. Let's quick get in the lab and figure out how we can blame this on something else. There's no way, right?
I don't know. We talk about how sometimes the way that CPI is calculated is so screwy, especially like the shelter components.
Yeah, but I mean, Sweden has 10.4 million people living
About
in
the
it.
size of
It's
North Carolina.
about the size of North Carolina. So, I mean, if there's a big show in Charlotte one night, is that going to shake the entire state's economy of North Carolina? I wouldn't think so.
I guess it depends how much hotel prices rose.
This feels to me like, we're unhappy with our 8% inflation. Let's find a reason to have missed the number.
Are you saying
for the
blame the
month.
Americans?
I'm saying I think Sweden's like deflecting, and they talked about, they had some Swedish economist in it talking about it. Which, okay, and even if you agree, say maybe Beyonce's shows had something to do with it, it's a temporary shock. Like it should come out in the wash next month, if that is what
So
you
we'll
plan
see.
on.
There is another economist that says while entertainment and hotel spending was high in May, it was not enough to be historical outliers. Yeah, I don't know. You guess you'd really have to dig into Sweden's inflation print to figure out what was going on. It feels like an easy excuse.
It feel right. That's what I'm saying. I feel like it's.
I think there were some other shows in Sweden outside of Stockholm. Or no, there was also a Bruce Springsteen concert.
In Gothenburg.
Wherever that is.
Haven't heard of that one. But I this feels like a clickbaity article. I'm not a fan of this. I don't know. I think it's a little ridiculous. The numbers would have to be so huge. I would think hotel prices would have to be 10x. Something crazy.
Yeah, I don't know. Feels like something to dig into the official statistics with.
Yeah, embrace debate there. I don't know.
This is my favorite one.
This is a good one.
Hate baggage fees. This is a Wall Street Journal one. Hate baggage fees. Wear a fishing vest on the plane.
This is awesome. As someone who just flew in a plane last week, and to check one bag, first bag was $70. $70 for a single bag.
I think that's why most people try to bring carry-on.
Yeah, I did carry-ons, but maybe next time I should remember the fishing vest.
Part cost, part convenience, right? You don't have to wait.
Yeah. Oh yeah.
To get your bag.
Definitely.
So there's this, I guess, increasingly popular trend of people wearing fishing vests. Like, think if you were going fly fishing, like one of those vests that someone would wear with all the pockets on them, and people are wearing them and stuffing the pockets full of clothes. I think they said there's bigger pockets on the back, so you can fit a computer in there. And then they just wear it onto the plane because it doesn't count as luggage.
It's awesome.
It's a jacket. Not only are people wearing fly fishing vests, they are also stuffing pillows with clothes. I guess like those travel pillows.
Yeah.
Yeah. Fill those with clothes. Just cram them in to circumvent the rules. But I don't know. If you see someone with a fly fishing vest on a plane, this could be a reason why.
I'm all in on this. This feels like a great idea to me.
I think it is a very creative solution. Would I personally wear a fly fishing vest on a plane? Probably not.
Hey, if it came to it.
I guess if it came to it, yeah.
I guess, one, do you care what you look like on a plane? I know this is a very, like, some people dress up for planes. Some people wear pajamas on a plane. Do you care how you look on a plane? What's your,
I guess
your typical...
on the scale of pajamas to dressing up, I'm not going to wear a suit onto a plane unless I have to. I'd probably say more athleisure.
Athleisure? Okay, that plays. I'd say I'm in that camp. But hey, maybe if you just wear like cargo pants and a fishing vest, you don't need to carry a thing. You can probably fit a weekend's worth of clothes and all that.
Yeah, might as well go all out then.
There's the one person in the article who said she fit multiple days of clothes in her fishing vest.
Yeah.
And said it was a little uncomfy to sit in the seat, but hey.
If you were to go cargo pants, you could also probably wear a hoodie and shove stuff in the pocket and then put the vest on top of it. You might not even need a carry-on.
You send me on vacation during the Phillies playoff run, maybe I'll give it a go.
Yeah, gonna report back.
Yeah.
Thoughts for the week?
Interested to see where we go with the market. Obviously, we're giving a little bit back today. Obviously, we can't continue on this trend forever. Kind of the more quickly we go higher, the higher the chance we get a little bit of moderation or pullback. Not unexpected. Not gonna panic if we see that, but it'll be interesting to see how where the market finds itself after that spike up last week.
I believe Powell speaks tomorrow. So people probably that feels like the most tradable thing of the week that people will be looking into for insight.
Always entertaining in front of Congress.
Yes, I'm sure he will get asked some very well thought out questions. But people are gonna be looking for signs about the Fed's next move. Are they gonna hike again? How much are they gonna hike? Are they gonna pause? So might see the rate market move off of that. But aside from that, feels like get to the end of the quarter, and then markets are most likely gonna be looking for earnings insights next month.
Would be nice, like if inflation comes down to those numbers that we discussed earlier, if the Fed starts debating quarter point hikes at the end of 5.5% of hiking, in earnings stabilize to, continue to look upwards, all sounds great compared to where we were 12 months ago. So I think all welcome developments, and excited to see kind of how that continues to develop.
And like we've seen this year, bond bag can go up, even if rates rise. I think last year was just that shock that rates rose so much more than expected. All right, see you next week.
Sounds good. See you next week.